Well, good day, traders. Chris Weston here, Head of Research at Pepperstone. So we're looking at a fairly defiant show of force from the PBoC. These guys obviously have a wide range of tools at their disposal that they can to try and calm markets, and they're using pretty much as many as they can. And there had been some talk on the floors from a PBoC advisor that they may come out at some stage and look to cut the medium lending facility, or they abbreviate to the MLF, as well as some of the other sort of short-term open market operations. Really, the idea is that when we do see the prime rate coming out, the China's prime rate, the 1 and 5 year rate coming out late February, that should lower, and the ability for businesses to get cheaper financing is obviously going to be there. But we have seen other measures as well. On the liquidity front, you've seen 1.2 trillion yuan being pushed through the money markets, and that should keep highball rates fairly suppressed going forward, which is obviously a good situation. Those interbank costs are something that we are quite concerned with at times, but the idea that the net effect of a liquidity boost going through the market, some of that gross amount will go into offset some maturing some short-term maturities, but ultimately there is a net effect that goes through and a reasonably punchy amount going back into the markets there. So yeah, the market should be buoyed up by that, but again, people aren't getting too carried away. This is a measure to try and fight a fairly punchy fire that we're looking at quite closely here. You've seen the Chinese coming out and fixing their currency at 12:15 Eastern Daylight Time, and we saw that probably less aggressive what the market was looking for. Therefore, people are suggesting that the PBoC want to have a stable currency. We've seen the offshore Chinese yuan, the currency that we offer to clients, weakening a bit today. You'd imagine probably you're going to see that situation when people are looking at liquidity. Textbook theory would suggest you get a better liquidity coming into the market, you're going to see a weaker currency. But we had also anticipated, every time we see any kind of good news around what's happening in the coronavirus, about the perception of China's economy, you do see a strengthening currency. So we thought maybe there was a possibility we could see traders coming out and buying the offshore yuan, but that hasn't been the case, and you've seen that back above the 7 handle. Now, what we've also seen today is all these various measures that have been taking place have resulted in some calming of markets. If you have a look at the Chinese equity market, we know that was closed for a number of days, and that the CSI is currently down about 8% at the moment, so that's not a particularly great story there. You've also seen Shanghai commodities such as rubber, iron ore, copper, and various other factors, palm oil, for example. They went limit down on the open there, as you'd imagine. There's been no buyers and a lot of sellers, and you see a situation where it goes limit down on the session. Then you go out to some of the other Asian markets, which of course have been open for some time, and they have been part infused by what we've seen from the PBoC. Take the Hang Seng, for example. That market's now up as I speak. Just before the Australian close, we're up 0.1%. The Nikkei is down 1%, but it's not a particularly ugly tape. You've got dollar yen, which is making very, very small grounds going higher. You've got S&P futures, which are up at about 0.5% higher at this stage as I speak. The ASX is down 1.1%. We're off the lows, but certainly there's no real panic in the selling and the tape we're seeing there. So I think, you look at currencies and you've got Aussie yen moving a little bit higher. I love looking at Aussie yen. I think that's a really good proxy. It's got a very strong correlation with S&P futures. But what I am quite concerned about there is that the implied vol, if you look at 1 week implied vol in Aussie yen, still sits around 12%. It's a level now which I think is still very elevated, getting into that top sort of standard deviation that we've been seeing. And that tells me that markets are still on edge and expecting big moves. So until Aussie yen implied vol comes down, I expect to see this market still on edge. And that makes a lot of sense. Have a look at the news flow. The cases of people contracting the coronavirus is still increasing. People are talking about exponential moves. Until that really starts to plateau, I think volatility is going to stay fairly high. The measures that are being put in place and the news flow still seems to be that there's a lot more to play out in this story. But for now, the authorities that we've been seeing in China, certainly the PBoC, are doing what they can, and I think the market's sensing that could be very, very important for the capital markets. But the fact that the Chinese mainland markets are still down hard suggests that there's still more to play out in this as well. So one thing we are watching, we're going into tonight's session in the US. I think it'd be interesting to see how the US trade this, whether S&P futures can maintain these levels, whether or not there's going to be any kind of solace being taken out into European equity markets. Tomorrow is going to be an interesting one. Of course, we've got our eyes firmly on the Aussie dollar. Will the RBA cut rates? Probably not. There's a 1 in 4 chance of that happening, that we get a rate cut there. But if you have a look at the response from this tightening of financial conditions coming from financial markets, the market's getting very excited. We're now going to see a central bank response from developed markets. We've seen that from the Sri Lankan central bank. That was a surprise. We've heard from the Korean central bank talking about potentially doing more to stabilise markets. But now do we see that from developed markets? So the RBA, if we don't see a cut in the February meeting, which is unlikely, and we'll probably hear from Dr. Lowe later on Wednesday talking about potentially what's happening in the virus and downgrades to the Chinese economy. But have a look at what's happening in the Australian dollar, because we expect to see a pretty good chance that there's going to be an April cut, a March cut. There's at the moment there's about a 50-50 chance there in going to the Fed, and you can see that the market's now pricing in 2 rate cuts by the end of the year. That first one really being fully discounted by around sort of June, July, with a really good chance that you're going to see a rate cut coming through in that April meeting there as well. So the central banks are expected to enact, given what we've seen from this tightening of financial conditions. What will the RBA say tomorrow? And of course, we've got our eyes firmly on the Iowa caucus as well. Bernie Sanders is obviously expected to do pretty well there, and I don't think the world's ready for a Bernie Sanders Democrat nominee, let alone a presidency. So we'll have to see what's happening there as well.